You follow the rules. You budget, you cut back, you work harder every single month, but somehow you're still losing ground. You feel it at the checkout counter when groceries demand a little more of your paycheck. You feel it when your rent climbs, and you definitely feel it when layoff announcements slowly start creeping into the headlines. By 2026, those separate frustrations are on track to merge into a highly specific economic condition. It's called stagflation. In a normal environment, saving more and spending less keeps you safe. But this particular economy actively punishes those exact habits. The standard financial playbook stops working, and you end up completely boxed in. Look at how a healthy economy balances itself on this scale. If inflation runs hot, strong economic growth usually pulls your wages up with it. And if we hit a recession, demand drops, which typically forces prices to cool down and offer some relief. Stagflation breaks that natural mechanism. First comes stagnation. Economic growth slows, businesses hesitate, and new hiring freezes. Then comes the inflation half of the equation. While growth is locked down, the cost of everyday survival, your food, your housing, your utilities, rockets up. You absorb the penalties of both conditions at the exact same time. You lose the rising wages that usually help you survive high prices, and you lose the falling prices that usually help you survive a weak job market. This traps households in a mechanical double bind. Your paycheck loses its buying power, while your career loses its security. To see how this attacks your day-to-day life, we have to start with the money you've already managed to save. This static block represents cash savings. Next to it are your essential costs: food, energy, and housing. On paper, the numbers haven't moved, but as those cost of living blocks expand, your idle cash covers less of your actual life. When inflation stays elevated and economic growth stalls, relying on a traditional savings account mathematically guarantees that you will slowly grow poorer. So if parked cash loses value, you need to generate new money. But stagflation attacks your active income. When macroeconomic growth stalls, companies immediately pivot to defense. They cut ambitious projects, delay new hires, and freeze internal promotions to protect their margins. That creates a severe career squeeze. Your professional momentum flatlines at the exact moment your monthly bills demand a higher salary. Keeping your job might feel like a victory during an economic slowdown, but if your paycheck stays flat while the baseline cost of survival climbs, you are still taking a pay cut. Once your savings are draining and your income is stalled, the pressure hits a third, much deeper level: your ability to plan for the future. The immediate stress of paying next month's bills consumes all your mental and financial resources. Maybe you wanted to buy a house, invest more, or build a stronger retirement plan. In a stagflation environment, all of that becomes more difficult because you're trying to plan long-term while being attacked by short-term pressure every single month. This creates what economists call a confidence crisis. Constant financial suffocation forces people to alter their daily habits. Fear takes over, and households simply stop spending money. We can track exactly how this spreads on this flowchart. Families reduce their spending, which forces local businesses to freeze hiring. That weakens the broader economy, which circles right back around to cause even less spending. The psychological fear of the individual accelerates the economic suffocation of the entire system, locking the trap shut. Faced with this kind of pressure, the most common human reaction is to wait. We assume the markets will eventually normalize on their own. Passive endurance is a fatal strategy here. If you wait for the economy to fix itself, you absorb the maximum amount of financial damage while the cycle plays out. The people who survive difficult economic cycles intact are rarely the ones who react after the panic starts. They are the ones who position themselves before it arrives. Defending yourself requires immediate, proactive adjustments across your static savings, your active career, and your long-term investments. In Part 2, we break down the practical, mechanical strategies designed to armor those three specific fronts against a stagflationary economy. Waiting until 2026 to figure out your strategy means taking the hit. Most of us navigate our financial lives on autopilot. We keep our cash in the usual accounts, stick to our standard savings habits, and rely on the convenience of automated routines, because historically, that setup has felt incredibly safe. But if the economy enters a period of stagflation in 2026, those standard routines become a liability. We are not talking about a sudden, dramatic market crash that dominates the evening news. The real threat is a long squeeze, a slow bleed that drains your wealth so quietly you might not notice until you are already in trouble. This diagram illustrates the mathematical trap. Two opposing forces. Rising inflation pushes living costs higher, while weak growth stalls wages. Caught in the middle, your purchasing power takes pressure from both directions. As this block shrinks over a timeline, sitting still actually means moving backward. Because if stagflation becomes a major risk in 2026, then waiting and hoping is not a strategy. Preparation is. The goal now is to build what we can call a personal anti-fragility system, a setup designed to hold up under stress. Relying on convenience in this environment creates a trajectory toward being trapped by rising prices and stagnant income. Avoiding that outcome requires a different logic for how we handle our capital, our careers, and our households. The first pillar of defense is your capital. Leaving large balances in low-yield checking or savings accounts might be easy, but that convenience is actively costing you. When prices rise all around you, idle cash loses its strength every single month. That loss of strength is accelerated by the invisible leaks in your daily life. It is the subscription creep, services paid for but never used, and lifestyle inflation from older habits. Now is the time to become ruthless with inefficiency. Every single wasted dollar you recover is another dollar added directly to your financial resilience. That doesn't mean making reckless bets. It means building layers of protection, cash for short-term needs, productive investments for long-term growth, and some exposure to assets that historically tend to hold up better when inflation stays stubborn. Depending on your situation, that could include inflation-aware investments, commodities exposure, value-oriented assets, dividend-paying companies with pricing power, or hard assets that are less vulnerable to currency erosion. The exact mix depends entirely on your personal risk tolerance, but the principle applies to everyone. Stop leaving your wealth exposed. If inflation is the threat, your money must be given a specific job. Even with a perfect portfolio, your largest financial asset is likely your earning power. And when corporate budgets tighten during a weak growth environment, company behavior becomes entirely predictable. When companies are under pressure, they don't just ask who works hard, they ask who is essential. Your mission is to make yourself incredibly difficult to replace. That requires upskilling in high-value areas, learn to work with automation, improve operational systems, solve expensive problems that increase revenue, connect your daily tasks directly to the company's bottom line. Second, think about industry resilience. Not all sectors suffer equally. Some industries remain stable because they provide services people and businesses still need no matter what. Healthcare, utilities, essential infrastructure, repair services. Before those budgets tighten or layoffs are announced, strengthen your professional visibility. Document your achievements. Clean up your resume. Reconnect with former colleagues now. In difficult economies, opportunities move through trusted relationships long before they ever reach a public job board. The modern workforce operates under a strict new rule. And remember, job security today is no longer just about loyalty, it's about relevance. Once your individual income and assets are defended, you have to look at the broader structural integrity of your entire household. Resilience starts with the emergency fund. This liquid buffer provides you with a specific, measurable resource: time. If your income drops or your expenses spike, a buffer of time prevents you from making desperate, expensive emotional decisions. It gives you room to search for work and map out a rational plan. The second part of resilience is debt reduction. If you carry high-interest debt into a stagflationary period, you enter the storm already leaking cash. Inflation hurts you on one side, interest payments hurt you on the other. That combination becomes brutal. Third, build what I call a personal anti-fragility system. That means not depending on one income stream, one employer, one skill, or one financial assumption. Monetize a specific skill. Build a freelance side income. Can you build side income? Can you freelance? Consult. Reduce dependency on one single source of stability, so your household never depends entirely on one employer. True resilience requires open communication about spending priorities and savings goals. When a household discusses what gets cut first and actively builds extreme flexibility into how they earn and live, they handle pressure far better than people forced to improvise in a panic. Consider the worst-case scenario for 2026. Sticky inflation continues to drive up the cost of groceries and energy, while stagnant economic growth freezes wages and sparks widespread layoffs across vulnerable sectors. The people who fail to prepare will experience a long, slow choking effect. Their static savings will sit idle, while the real cost of living relentlessly outpaces their stagnant income. Waiting for proof that the economy is broken is the most dangerous choice you can make. If you delay until everyone else is feeling the pain, the best opportunities to reposition yourself will already be slower, harder, and significantly more expensive to access. Looking at this half-finished roof against these clouds, the window for preparation is clearly defined. You cannot finish the structure once the storm has already arrived. So remember the 3 big moves. Diversify your assets to defend your purchasing power. make your skills undeniably essential at work. And protect your future by building emergency savings, reducing dangerous debt, and increasing flexibility in how you earn and live. You do not need to predict the future perfectly. You just need to become more prepared than you were yesterday. What is the first step you plan to take to protect yourself? Let me know in the comments below, and make sure to subscribe.